I am AI Avatar of C. Ratan Mundra. India's latest macro-financial signals point to easier borrowing conditions. Policy rate cuts, durable liquidity injections, and improving banking stability are shaping FY26. In this video, we break down what has changed, who benefits the most, and what borrowers should watch out for. First, the policy backdrop. The repo rate stood at 5.25% as of December 2025, marking a clear easing cycle. A 100 basis point reduction in the cash reserve ratio to 3% was expected to release around 2.5 lakh rupees crore of primary liquidity into the banking system. In parallel, durable liquidity was injected through open market operations, 2.39 lakh rupees crore during April-May 2025, with additional support later. As a result, system liquidity remained in surplus through FY26, supporting credit flow and transmission. The key question for borrowers is whether banks passed on these policy benefits. According to the survey, transmission has been robust amid surplus liquidity. For scheduled commercial banks, the weighted average lending rate on fresh rupee loans fell by 64 basis points to 8.71% by November 2025. Rates on outstanding loans also declined by 56 basis points to 9.21%, the lowest level since September 2022. This confirms that easing at the policy level is translating into real borrowing cost relief, though not uniformly across all loan products. MSMEs are among the clearest beneficiaries. In November 2025, bank credit to MSMEs grew by 21.8% year-on-year, compared to 13% a year earlier. Credit to micro and small enterprises grew even faster at 24.6%. This momentum was supported by updated collateral norms, enhanced credit guarantee coverage, micro-enterprise credit cards, and revised MSME classification thresholds. For households, lower lending rates reduce EMIs on floating rate loans and improve affordability for new borrowing. However, easier credit also increases the risk of over-leveraging if income growth does not keep pace. In the microfinance and inclusion segment, access continues to expand for low-income and rural borrowers, supported by digital public infrastructure such as UPI and Aadhaar-enabled services. At the same time, responsible lending and cash flow assessment remain essential. Lower lending rates translate into tangible savings for borrowers. Illustratively, a 50 basis point reduction on a 50 rupees lakh home loan over 20 years can reduce EMIs and save several lakhs over the loan life, depending on reset terms. For MSMEs, even a 50 to 75 basis point reduction in working capital rates can significantly improve monthly cash flows and interest coverage, especially in tight operating cycles. Beyond pricing, surplus liquidity has also improved credit availability. The survey reports a sharp rise in overall flow of resources to the commercial sector, supported by strong non-food bank credit growth. Despite positive conditions, three watchouts remain. First, transmission is not uniform. Actual rates depend on loan type, benchmark linkage, and reset timing. Second, rapid credit expansion can create repayment stress if underwriting standards weaken, particularly among financially vulnerable households. Third, the survey highlights that sustainable low interest rates also depend on structural factors such as savings behavior and external balance risks. Current relief should not be mistaken for permanently cheap capital. To sum up, FY26 reflects easier liquidity and improved monetary transmission, with clear positives for MSME credit flow and broader borrowing conditions. The biggest benefits arise when lower rates are matched with responsible borrowing, sound underwriting, and durable macroeconomic stability. Moonses and Management Consultants LLP, a trusted partner for SEZ and IFSC excellence, a pioneer in establishing SEZ and IFSC units within GIFT City and India, delivering end-to-end IFSC setup, operational support, and handling complaints, risk management, renowned for deep expertise in regulatory approvals, capital markets, fund management, insurance, finance company, foreign university BATF, and ancillary regulations. And FinTech, expertise in customs clearance for aircraft and ship procurement, leasing, GST, DSPF, IFSCA comprehensive support covering registration, reporting, and regulatory transitions, ensuring ring fencing, transparency, and global compliance standards. Join our network, scan the QR codes below to stay connected with us.